Welcome to this explainer. Okay, today we are diving headfirst into the really fascinating world of banking and money. If you're prepping for your exams and need to tackle Chapter 4, Banking and Monetary Policy, well, you are in the absolutely perfect place. We're going to break down this entire textbook chapter into easy, plain English. We'll demystify what banks actually do all day, how the Reserve Bank of India literally pulls the strings of our entire economy, and exactly what all those confusing terms, like repo rate and CRR, really mean. I'll be your guide today, and by the end of this explainer, you're going to have a crystal clear, solid understanding of this whole system.
So, here is our quick roadmap for today. We'll start with the meaning of banks, then see commercial banks in action. After that, we'll look at the RBI, India's apex bank, define what monetary policy actually is, and finally, wrap up with the quantitative policy levers and the qualitative policy measures.
But hey, before we get into the heavy definitions, just think about this for a second. Ever wonder how your local neighborhood bank actually makes money from your deposits? You put your savings in, they keep it totally safe, and they even pay you a little bit of interest on top. Sounds like a sweet deal for you, right? But how do they profit? Well, the answer to that question is literally the foundation of our entire modern financial system. And to answer it, we actually need to step back in time.
All right, let's get into Section 1, the meaning of banks, from benches to business.
The history here is actually pretty literal. The English word bank comes from the Italian word banca or the French banque. And you know what both of those words meant? Just a bench. Back in the old days, European moneylenders and changers would set up right in the public market, displaying these heaps of coins from different countries on large wooden benches or tables. They were the original currency exchangers. And over time, that simple little bench evolved into the massive, complex institutions we know today.
Fast forward to today and we have the commercial bank. So the absolute crucial takeaway here is this. Your local bank is not a charity. It is a profit-seeking commercial business. Sure, they accept your savings as deposits, but they don't just lock those bills away in a dusty vault. No, they actively lend that money out to people who need it to buy homes or start businesses. They charge those borrowers a higher interest rate for the loan, and they pay you a lower interest rate for your deposit. And that difference, that right there, is their profit.
Moving right along to Section 2, Commercial Banks in Action, the Orchestra Musicians.
Think of commercial banks as the everyday musicians in a massive economic orchestra. They're the ones playing the everyday instruments. For your exams, here are the primary functions you definitely need to know. First, they accept deposits, whether that's a flexible current account, your standard savings account, or a high-interest fixed deposit. Second, they provide credit, meaning they give out short, medium, and long-term loans. Third, they offer everyday payment and withdrawal facilities, like processing checks and running ATMs. They also handle interbanking transactions, where they lend money to each other. But I really want to draw your attention to that fourth point, credit creation, because this is where banks do something truly, truly incredible. This right here brilliantly illustrates the absolute magic of credit creation. See, a bank can't legally lend out every single rupee you deposit. They have to keep a little fraction aside for safety, which is called a reserve ratio. Let's say that ratio is 20%. If you go and deposit 1,000 rupees in Bank A, they keep 200 rupees safe and lend out the other 800 rupees. The person who borrows that 800 rupees uses it to buy something, and that money eventually gets deposited straight into Bank B. Now Bank B keeps 20% of that, which is 160 rupees, and lends out 640 rupees. As this process ripples through the whole banking system, your initial 1,000 rupees actually creates $4,000 in brand new loans, boosting the total money supply to 5,000 rupees. So banks are actively keeping money moving to generate profit and expand the entire economy.
Which brings us to Section 3, RBI, India's apex bank, the conductor.
Now, with all these commercial banks constantly multiplying money out there, things could get totally chaotic real fast without a conductor. That's the Reserve Bank of India, established back in 1935. It is super important for your exams to understand the exact difference between the two. Commercial banks, they're driven purely by profit. They deal directly with you and me, the general public, to mobilize savings. The central bank, the RBI, is totally different. They are driven by the welfare and stability of the entire nation. They do not deal with the general public at all. Instead, they interact only with commercial banks and the government to regulate the entire money market.
As the supreme conductor, the RBI's daily responsibilities are just massive. They issue our currency, specifically notes of 2 rupees and above. Fun fact, the 1 rupee notes and coins are actually handled by the finance ministry. The RBI also acts as the official banker to the government. They are the banker's bank, meaning they regulate all the scheduled banks and act as the absolute lender of last resort if a bank faces an emergency. They maintain our foreign exchange reserves to keep the rupee's value nice and stable. And crucially, they control credit.
All right, Section 4. What is monetary policy? Controlling the tempo.
So how exactly does this conductor control the tempo of our economy? Well, by definition, monetary policy refers to the conscious steps undertaken by the apex bank, the RBI, to regulate the supply and the cost of money. And why do they do this? Simply put, to maintain economic stability. It's a really delicate balancing act. If there's too much money chasing too few goods, boom, you get inflation. Prices just skyrocket. But if there's too little money, you get deflation and a slowing economy. The RBI uses monetary policy to keep that money supply just right.
Let's see how they actually do it in Section 5, the quantitative policy levers pulling the macro strings.
Think of quantitative policy as these massive economy-wide strings the RBI can pull that end up affecting absolutely everyone. The first major tool here is the bank rate. Let's look at the direct chain reaction. If the economy is running way too hot and inflation is rising, the RBI steps in. Step 1, they increase the bank rate, which is the rate they charge commercial banks for long-term loans. Step 2, now commercial banks find it much more expensive to borrow money from the RBI. Step 3, to cover those new costs, the commercial banks raise the interest rates on the everyday loans they offer to you and me. And Step 4, because loans are suddenly expensive, people borrow less, they buy fewer cars and houses, overall demand drops, and inflation finally cools off. It's a literal domino effect.
And guys, these aren't just dry textbook theories. They are active, real-world tools used every day. For example, back in April 2016, the repo rate hit 6.5%. Now you might be asking, what exactly is the repo rate? Well, while the bank rate is for long-term borrowing, the repo rate, which is short for repurchase rate, is used when commercial banks need funds for a very short period, sometimes just a couple of days. They sell securities to the RBI with a strict agreement to buy them back. By tweaking this short-term rate, the RBI actively manages the day-to-day cash flow of the entire country.
Next up for quantitative levers, we have the reserve ratios. Remember that awesome credit creation magic we talked about earlier? Well, the RBI dictates the exact rules of that magic. First is the CRR, the cash reserve ratio. This is the absolute minimum percentage of cash deposits that commercial banks are legally forced to lock away with the RBI. It can vary anywhere from 3% to 15%. Second is the SLR, the statutory liquidity ratio. On top of the CRR, banks must also hold at least 25% of their deposits in liquid forms, stuff like cash, gold, or approved government securities. By raising these ratios, the RBI forces banks to lock away more funds, and less money available to lend equals a shrinking money supply, which helps fight inflation.
There's another fascinating broad-stroke tool called open market operations, or OMOs. Let's say the RBI wants to quickly, drastically reduce the amount of money floating around out there. Step 1, the RBI simply sells government bonds or securities in the open market. Step 2, commercial banks and everyday individuals buy up these nice, secure bonds. Step 3, to pay for them, cash flows out of the open market and straight into the RBI's vaults. And Step 4, just like that, the RBI has literally vacuumed excess cash right out of the circulating economy. Pretty clever, right?
Finally, we reach Section 6, the qualitative policy measures, targeted credit control.
So we've seen the big, blunt instruments. If quantitative tools are like a giant sledgehammer, qualitative tools are a precision scalpel. These are selective controls because they definitely do not impact everyone equally. The RBI uses these to carefully guide development in specific needed sectors. They can alter security requirements, meaning the actual collateral you need to put up to get a loan. They can adjust margin requirements, which is the percentage of an asset's total value they'll actually grant you a loan for. They can put absolute ceilings on credit, strictly limiting how much money flows in certain industries. And they can also utilize discriminatory interest rates.
To really make that last point concrete, let's look at this specific example. Discriminatory interest rates mean the RBI can actively steer the economy toward overall social welfare. For instance, they can mandate a lower, highly affordable interest rate for a struggling farmer who urgently needs equipment to grow food, while simultaneously ensuring a much higher interest rate for a wealthy business person taking out a loan just to buy a luxury sports car. It's designed to ensure balanced development across all layers of society.
And wow, that brings us to the end of Chapter 4. You've seen the whole hierarchy, from your local commercial banks multiplying deposits all the way up to the RBI conducting the entire economic show using both massive macro levers and those targeted surgical tools. So I want to leave you with this empowering thought. Next time you see a news headline flashing that interest rates have changed, ask yourself, what is the RBI trying to fix in the economy right now? Are they trying to cool down rising inflation? Or are they trying to pump up a sluggish economy? You now have the foundational tools to completely decode the real-world financial news happening all around you. Thanks so much for joining me on this explainer, and keep exploring.